If you have been buying Bitcoin periodically for a few years, you have done very well. But what if I told you that there is a strategy that can literally double your profits with minimal risk? The best part, this strategy is so simple that you can start applying it yourself right now. So in this video, I'll explain the idea of this strategy, I will show you the result you can get, and I will share with you step by step how you can apply this simple strategy yourself. And at the end, I will show you the most efficient way to maximize your gains with Bitcoin. So make sure you watch until the very end. So everything I'm going to show you today, I'm going to test it. I'm going to back test it based on the historical price of Bitcoin, and I will back my result based on real data. So you can see for yourself how well it really works. So let's start with the baseline. The baseline is to apply dollar cost averaging. So with dollar cost averaging, what you do is that you buy periodically every week, every month, or every day, a fixed amount of Bitcoin. So for example, you buy $100 of Bitcoin every week. And if you do this periodically and if you do this long enough, you smoothen the price action of Bitcoin. So you avoid buying at the top and you accumulate more Bitcoin at a lower price on average, so that over time, your result, you will get more result, more profits, and the value of your Bitcoin will be worth more than the value of the dollars that you place to buy your Bitcoin. So let's see how well it works in practice. So for this, I wrote a script that uses the real price action of Bitcoin, the real historical price of Bitcoin since 2020. And that simulates the fact of buying a fixed amount of Bitcoin every week. So for example, if you buy $100 of Bitcoin every week since 2020, every Monday, here is the result that you would get. So here in orange, this is the amount of money in dollars that you would have spent. So since you buy a fixed amount, $100 per week, the amount that you invest simply increases linearly and steadily with time. That's the amount that you invest. And now in blue, this is the amount of the Bitcoin that you would have purchased. So since Bitcoins tend to appreciate over time, the value of your Bitcoin tends to increase, and it tends to increase faster than the money you invest. So over time, the blue lines becomes much higher than the orange line, which means that the value of your Bitcoins is significantly larger than the value that you would have invested. And so if you look at those results, if you would have invested $100 of Bitcoin every week, every Monday since 2020, you would have invested $29,000, but the value of your Bitcoin would be about $129,000. So that's a return of 335%. So that's more than a 4x return on your investment. So that's pretty good, and that's why DCA is a very good strategy. But we can do better. Actually, we can do about 2 times better than that. So let's stick until the end. I will show you exactly how you can get much higher return than that. And the idea of this is, what if instead of buying Bitcoin every week, what if we could buy more Bitcoin when the price of Bitcoin is low? And what if we could skip buying Bitcoin when the price of Bitcoin is very high? And the reason for that is that when you look at the price of Bitcoin over time, it's a very cyclic market. You have some periods where Bitcoin increases a lot, then it tends to drop a lot, and then re-increases a lot. And it has been doing that since really the very beginning of Bitcoins. So what if you could buy Bitcoin at the very bottom and avoid buying at the very top? Well, this is something that is very difficult to do. And actually, most people tend to do the very opposite. Why? Because when Bitcoin increases a lot, that's typically when you start hearing about Bitcoin and how much it has been growing. So this is when you will be tempted to buy Bitcoin because you will think it will continue increasing a lot. And so that's the risk here, that you're going to buy Bitcoin at the very top, and right after you buy, it starts dropping. And on the other hand, when Bitcoin drops a lot, when the price of Bitcoin becomes very low, this is typically where most people will start panicking. This is where they will start worrying that it's going to drop even more. And that's typically when they will start selling their Bitcoin. And that's why most people lose money. It's because they buy Bitcoin at the top and they sell at the bottom. And the market is really designed to make you do that. And this is typically what's going to happen if you just buy or sell Bitcoin based on your emotion, based on what you think. And rather than doing that, what you need to have is to have a plan. You need to have a strategy. And here I'm going to show you a very simple strategy, a very simple plan with predetermined rules. So you never have to guess if Bitcoin is at the top or a bottom. You simply follow the plan, you follow the rules, and based on that, historically, you will get much better return than simply dollar cost averaging your Bitcoin. So the idea of this strategy is that rather than trying to simply buy every week Bitcoin, whether it's high or very low, and rather than trying to guess when Bitcoin is at the top or when Bitcoin is at the bottom, we will define some rules that will allow you to get on average more Bitcoins when the price is low and less Bitcoins when the price is high. So let me describe what this strategy is about. And for this, all you need is a very simple indicator that most likely you have already used, which is the simple moving average. The idea of simple moving average is that at any time, at any day, you take the average of the price of Bitcoin over the last 20 days, or over the last 30 days, or over the last 100 days. So you take the average of what was the price of Bitcoin over the past. So that's the simple moving average. At any day, you look at what was the price over the past days, you take the average of this price, and that gives you the simple moving average. So for example, here, let's take an example where this is the price of a cryptocurrency over time. If you calculate the 5-day SMA, the 5-day simple moving average, that will give you this blue line. This blue line is going to be like a moving average. It's going to smoothen out the price of Bitcoin. And so at every day, you calculate this blue line by just taking the average of the 5 previous days. On the other hand, you can also do that with different duration for the window of the average. You can calculate the 30-day moving average, the 62-day moving average. And so the more the window is large, the more you smoothen the price action of the cryptocurrency, and the more you average out the results. So what's the interest of doing that? The interest of doing that is that when you calculate the simple moving average, here what I'm showing is in blue, this is the price of Bitcoin since 2020. And in orange, this is, in this case, the 100-day SMA, the 100-day simple moving average. You can see that every time Bitcoin is showing a top, the price of Bitcoin is higher than the SMA. And on the other hand, every time the price of Bitcoin is showing a bottom, it's going to be lower than the SMA. And this has to be true mathematically. The average, the SMA is based on calculating the average. So the average is necessarily going to be lower than the top and is necessarily going to be higher than the bottom. So mathematically speaking, necessarily, the top of Bitcoin will always be higher than the SMA, and the bottom of Bitcoin will always be lower than the SMA. So now what if we could apply those rules to try to buy Bitcoin when it's at the bottom and avoid buying Bitcoin when it's at the top? So for this, we need to define one more metric, which is the Z-score. The Z-score will capture how much higher Bitcoin is as compared to the moving average, or how much lower Bitcoin is as compared to the SMA moving average. So the idea of the Z-score is that you can calculate how much the price of Bitcoin fluctuates over time. And so you can represent this as some kind of a distribution where when the price of Bitcoin is exactly equal to the moving average, then the z-score is equal to 0. It means that the price of Bitcoin is right on its average value. That gives you a z-score of 0. Now, if Bitcoin is significantly lower as compared to its typical fluctuation of price, then the z-score will become lower and lower. The z-score, if you're familiar with the concept of standard deviation, the z-score tells you how many standard deviation away are you from the average. So the lower the price of Bitcoin is as compared to the average, the lower the z-score here is. And if you have a z-score of -2 or lower, then it means that Bitcoin is significantly underpriced. The price of Bitcoin is much lower as compared to the average value. So it's typically going to be a great time to buy. On the other hand, if the price of Bitcoin is significantly higher as compared to the average, if it's several standard deviation away larger than the average, then the z-score will be very high. You will have a z-score of 2, potentially 3. That means that in this case, Bitcoin becomes overpriced, and it's probably not a very good time to buy Bitcoin. So now let's see how it works in practice. So I wrote a function to calculate the standard deviation of Bitcoin, to calculate the average, to calculate the simple moving average and the z-score of Bitcoins. And let's see what it looks like. So here what I'm going to show you is the result if you use the 100-day simple moving average, and if you calculate based on that the z-score. So what I'm showing you here is the price of Bitcoin. So this is the same price as before. In orange, this is the 100-day simple moving average. And the price of Bitcoin now is colored based on the current z-score at any single day. So if the price of Bitcoin has a z-score between -1 and 1, then the price of Bitcoin is going to be in blue. That means the price of Bitcoin is close to the average. So it's not significantly overpriced. It's not significantly underpriced either. On the other hand, if the price of Bitcoin increases a lot, then the z-score will become larger than 1. This is what will be represented in red. This is typically not going to be a very good time to buy. On the other hand, if the price of Bitcoin becomes very low as compared to the simple moving average, if the z-score now becomes lower or equal to -1, then the price is now shown in green. And this is typically going to be a very good time to buy because the price of Bitcoin is undervalued. And this is going to be the base metric that we are going to use for this strategy. The idea is very simple, and you can start applying it yourself right now. If the price of Bitcoin is high, and if the z-score is larger than 1, then it's going to mean that Bitcoin is presently overpriced. And what we're going to do in that case is to just pause buying. We're not going to buy any Bitcoin when the z-score is larger than 1. If the z-score is between -1 and 1, that means that Bitcoin is close to its average value. That's when it's blue here. We're just going to buy a regular amount of Bitcoin, for example, $100 per week. And on the other hand, finally, if the z-score drops below -1, that means that Bitcoin is becoming very cheap. And here we're going to start buying a lot of Bitcoin. We are going to buy hard. We are going to accumulate Bitcoin by buying 4 times more Bitcoin than during the regular times when Bitcoin is in blue. So Bitcoin in red, you don't buy Bitcoin. Bitcoin becomes blue, you just buy your regular amount, just like if you did that with regular dollar cost averaging. And when Bitcoin becomes green, you just buy 4 times more Bitcoin because it means that Bitcoin is on sale. It becomes extremely cheap. It's a great time to buy Bitcoin. So this is the idea of a dynamic dollar cost averaging instead of the conventional dollar cost averaging where you buy the same amount of Bitcoin every week. Now we're going to modulate that and buy more Bitcoin when it's cheap and stop buying when it's expensive. So now let's see what's the result for this. So let's backtest this again. Let's back this up with data. Let's see how well it has worked based on a backtesting this strategy. So for this, what I'm going to use again is I'm going to buy my regular amount of buying Bitcoin will be $100 per week. So every Monday, you are going to look at the Z-score of Bitcoin. If the Z-score is -1 and +1, you just buy $100 of Bitcoin. If the Z-score is higher than 1, you just skip this week. You don't buy any Bitcoin. And if the Z-score is lower than -1, then you buy $400. You buy 4x your usual buy. You buy $400 of Bitcoin on this week. So let's see what it looks like. So again, this is the same types of result here. In orange, this is the amount that you would have invested. So now, because the price of Bitcoin is sometimes higher than the moving average and sometimes lower, the amount that you invest does not increase linearly over time, like in the case of regular DCA, because there is going to be some long period where you just stop buying altogether, and some periods where you buy hard $400 per week. So in orange, this is the amount in dollars that you would have invested over time. And in blue here, this is the value of the Bitcoin that you would have accumulated. So if you look at those results here by investing $100 of Bitcoin or $400 of Bitcoin, depending on its Z-score, this time you would have invested $46,900 since 2020 and 2025. But the value of your Bitcoin would be $169 and $198. So you would have a return of 358% return. So that's not bad. It's 28% more than regular dollar cost averaging, but we can still do much better than that. So make sure you continue watching. I will tell you how you can make even higher profit by really tuning and optimizing this strategy. But this shows you already that even if you use this very simple idea, you can already get more returns than if you're just buying using a conventional DCA dollar cost averaging strategy. So now let's see, how can we do even better? Well, for this, one thing that you can optimize is to pick the right window for the simple moving average. What if instead of using the 100-day simple moving average, what if you were using a smaller window or maybe a larger window? So when you calculate the average price of Bitcoin, what if you calculate the average price based on the last 30 days instead, or maybe based on the last 600 days? Well, the beauty of backtesting that is that we can just try all of those possibilities. We can try every single window from 30 days to 600 days and see simply which one has worked the best over time. So let's do that. Let's see what the results are if you try different value for the window of the simple moving average. So here what I'm going to show you first is how much the amount that you would have invested over the past 5 years would have changed depending on the value of the window that you are using for your simple moving average. So if you have used a very small window, so if you just use the 30-day moving average to define the Z-score and to define how much Bitcoin you buy, you will typically tend to invest a lot. This is because if you use, for example, a 30-day moving average, then very often Bitcoin will be higher or lower than the 30-day moving average. And so you will tend to overreact. And so very often you will end up buying 4 times more Bitcoin than usual. And so you will tend to invest a lot of money and you will tend to overreact to every simple small move of Bitcoin. Every small increase of Bitcoin or every small decrease of Bitcoin will make Bitcoin go higher or lower than its 30-day moving average. And so you will tend to overreact and you will invest a lot of money. In red here, this is the amount that you would have invested with a simple moving average, with a single simple DCA strategy. So you see that if you use a small window for your moving average, you will tend to invest more money than if you use a simple dollar cost averaging strategy. But if you use a long window, then you tend to be more conservative. You really only buy Bitcoin when it's significantly undervalued. And so you tend to invest less money overall. You really buy Bitcoin when it's really low in price. And so altogether, you tend to invest more money on the long term. So now let's see how the value of your Bitcoin depends on the window length that you are using for the moving average. So if you are using a small window, for example, a 30-day simple moving average, the value of your Bitcoin will tend to be a little bit lower. This is because, again, you tend to overreact and you tend to buy Bitcoin when it's actually not that cheap. But on the other hand, if you use a very large window, for example, a 600-day moving average, then you tend to be very conservative. You really buy Bitcoin very rarely. And because you buy Bitcoin very rarely, you get fewer Bitcoins. You get Bitcoin at a lower price, but you buy less Bitcoin. So the value of your Bitcoin tends to be lower because you buy Bitcoin more rarely. But now let's see what is the most optimal value for the window of your SMA. For this, what we can do is to look now at the return in percentage, right? To compare the value of your Bitcoin with the value that you have invested and to calculate the return percentage. And you see here that there is an optimal value for your SMA window, and it's 330 days. 330 days is the magic number for your simple moving average that allows you to maximize your return. You see that again, if you use a very small value for your SMA window, you tend to overreact and your return can be even lower than the return that is in red here, which is the return that you would have got with regular conventional dollar cost averaging. And on the other hand, if you have a very large value for your SMA window, you will also get fewer return because you use such a large value for the SMA that you are too conservative. You are not aggressive enough in when you decide to buy Bitcoin. And you can see that the maximum return is when you use this magic value of a 330-day SMA. And so let's see what's the return that you get. So if you use this strategy, you would get a return of 501% over 5 years. So that's almost a 6x return just in 5 years. And so you can see that this strategy will give you about 2 times more gains as compared to dollar cost averaging. So let's see exactly how this strategy would have worked over time. So you can see here, again, this is the price of Bitcoin. So now in orange, I have represented the magic 330 days simple moving average. And again, I have colored the Bitcoin based on the Z-score. So you can see that with this strategy, every time that Bitcoin shows a top, it's in red, so you would just avoid buying the top altogether. So every single top of Bitcoin, you would have avoided, by using this strategy, you would have avoided buying Bitcoin at every single top. And on the other hand, every time Bitcoin shows a bottom, then the Z-score becomes lower than -1 and Bitcoin becomes colored in green. So you would have bought a lot of Bitcoins, 4 times more Bitcoin every time it shows a bottom. By using this strategy, so you would have bought Bitcoin in 2020 when it was less than $15,000. You would have again buy some Bitcoin in 2022 when it went lower than $40,000, and you would have accumulated a lot of Bitcoin in late 2022 and early 2023 when the price of Bitcoin was close to $20,000. So by using this strategy, you would have completely avoided losing your money by buying Bitcoin at the top, and you would have accumulated a lot of Bitcoin when it's close to the bottom. So as you can see, it's a very simple strategy. It can allow you to really accumulate a lot of Bitcoin. It can make you have about 2 times more gains on average as compared to regular dollar cost averaging. And this strategy, you can use it right now. You can use the single moving average in your favorite charting tool like TradingView. So you can really apply this strategy right now and see how it works for you, and start accumulating more Bitcoins, and to doing it in a smarter way than if you were just using a conventional dollar cost average strategy. So now, do you have your own strategy? Like, do you have a better strategy that you are following yourself and that you have found to give even better results over time? So if you have a better strategy, please feel free to share it in the comments so that we can all learn from each other. And if you decide that you want to stick to simple dollar cost averaging, if you want to just use a simple DCA strategy, and if you don't want to move to a dynamic DCA strategy where you invest more at the bottom and less at the top, then you would be surprised that the day at which you buy Bitcoin matters more than you may think. And the best day to buy Bitcoin might not be the one that you think is the best. So if you want to find out what is the very best day to buy Bitcoin, the very best day of the week to buy Bitcoin, then make sure to watch this video.